are in a bog of uncertainty. We've been in one for quite a while, and now it's accelerating. Remember that half of the stock market, when you're valuing it, is about actual hardcore earnings. And then the other half is what is the multiple that investors are willing to slap on those earnings. And it's the multiple, what John Maynard Keynes said was the animal spirits. When the market multiple is moving up, it means investors are getting more and more confidence over that expected future earnings stream. And when the multiple is going down, it means that investors are losing confidence. So that's what's happening right now. What has changed really from the peak in the market in February isn't so much earnings, it's the multiple. It's the confidence and it's the nervousness and the response to this incredible shock. It's not like a COVID shock. It's not like a massive financial shock like we had in 2008, but it's the sort of shock that creates tremendous uncertainty. And when you have tremendous uncertainty from a financial market standpoint, it means that investors are compelled to become more risk averse and premium into the pricing of the assets that they're buying. So risk premium, not just the stock market. Look what's happening in the market for corporate credit. High yield spreads have widened out in a matter of 6 weeks by 200 basis points. Everybody looks at the stock market because they don't understand the corporate bond market. The corporate bond market has performed worse. In fact, the non-speculative grade market has performed worse than the stock market has. So it's a reflection of this uncertainty. And, I think what happened at the Rose Garden last week was epic, because you would have had pundits and strategist economists, and some of them were saying on other networks that this was going to be an inflection point to come back into the market because the uncertainty at least was going to be behind us. We were going to know what Trump was going to do on these reciprocal tariffs. The problem is that there's nothing reciprocal about them. They've created this formula for these punitive levies, which is basically the trade surplus each country has against the United States divided by their exports, and voila, that's why you have some numbers are say 10% and some numbers are 40%. Each country has its own number. And so the message was very clear, which is that the administration wants every country in the world that has a bilateral trade surplus with the United States to have it completely eliminated. So it's not even really a tariff, it's a ratio. I mean, in one fell swoop, the effective tariff rate of the United States on the rest of the world went from 2.5% to an average of 25%. We've already taken out, if these persist, goes over and beyond what was done in the 1930s with Smoot-Hawley. So that's what we're in right now. I think people were taken by surprise at the extent of what these so-called tariffs are going to be. I don't even call it a tariff. And people realize that, what are you going to negotiate? You can take your tariff rate down to zero, which is basically what Israel did ahead of the fact, thinking that they would be bypassed, but they weren't. So this is a message, and Donald Trump's been talking about this since the mid-1980s. He believes that trade surpluses against the United States are evil, that these are subsidies by cheaters and rip-off artists. The administration and all their economists, no matter how many PhDs from Harvard they have, seem to believe that trade deficits with the rest of the world are a bad thing. They have to be eliminated. And so there's nothing here to negotiate. The problem is trying to wrap around your head that this is an assault on a $33 trillion animal called global trade. If global trade was its own GDP, its own economy, it would be bigger than the United States. It'd be the biggest in the world. And so we've just done a massive assault on global trade, which has all sorts of spin-off effects within specific economies and regions, big impacts on all industries, because even the service sector feeds into the goods producing sector. So right now we're in this bog of uncertainty, and we went into this stock market correction with multiples at 22, 23, now they're down to 19, they're still above the historical norm. So although it's been gut-wrenching to watch what's been happening, there's probably still more to come over the near term just to get the valuations in line with the historical record. I think that the oil price story has two sides. The market, generally speaking, is pricing in recession risk across the credit market, across the equity market. And so why would anybody think the commodity markets would be immune? You could look and see, copper was surging ahead of the tariffs. Now it's collapsed. The base metals have collapsed. And oil is very cyclical. So oil is peeled back for the same reason why the overall stock market is peeled back. And on top of that, OPEC Plus is talking about it bumping their output increases next month. So you got the supply side coming back on stream from OPEC Plus at the same time that you're seeing estimates going down of global demand because of the increasing prospect of a global recession. So that's your story on the oil price. But the whole commodity complex is going down. It's not just oil. And in terms of the broader question of where do you hide, it's just a relative game. Nothing is immune from a recessionary bear market. It's a matter of degrees, and the old saying, in the land of the blind, the one-eyed man is king. So the one thing that we know is that interest rates are coming down. The markets are pricing in more Bank of Canada cuts, more Fed cuts. So you want to be in the more defensive, non-cyclical, what I call bonds and drag, or the bond proxies in the stock market that have defensive characteristics and decent dividend yield, dividend growth attributes. Now you can point to utilities, that would be one. You can point to consumer staples, that would be another one. You can also point to various aspects of healthcare, which is, things that we need. Consumer staples, which is basically, your cereal and your beverages, the things that you need, not the things that you want. So would all be making sense to me. I would really call the equity portfolio, if I had toes in the stock market now, I'd want to pick up yield, because yield is becoming scarce with interest rates going down, and I'd want to at least be in the industries that won't get crushed in an economic recession. And those are the three that would stand out the most. I was a little bit surprised at how strident his commentary was. He's still describing the U.S. economy as being solid. I think that's now in the rearview mirror. What was curious is that normally Federal Reserve in the past tended to be a little more preemptive, at least in their tone. And there's nothing preemptive about it. He's basically, as always, concentrating on coincident to lagging indicators and basically telling us that the economy is going to slow. He says there's no recession in our forecast, although I don't think the Fed's ever forecast a recession before, even when it's staring them in the face. And he's equally concerned over the inflationary impact of the tariffs. And this is what was so confusing, is he says on the one hand, we're concerned about that inflation is going to be more persistent because of the extent of the tariffs. But then he comes out and says, but there's no inflationary pressure coming out of the labor market. To which I say, well, if there's no inflationary impact coming out of the labor market, then the inflation is going to get snuffed out. There's no doubt that we're going to be in for a temporary inflation or price shock. But if there's no second round impact into the labor market, then there's no lasting inflation. It's just going to end up getting squeezed out because real wages will contract, and as real wages contracts, real consumer spending contracts, and that leads to lower demand, and then that brings you down probably to inflation rates lower than would otherwise be the case. And of course, we all miss transitory, and so did the Fed, back in 2021, 2022. But the reason why inflation wasn't transitory was because we had a huge mismatch in the labor market. The government was paying people not to work, and of course, because the aftershocks of COVID, people were scared to go back to work. The economy reopened, and we had all the stimulus, and companies were looking for labor they couldn't find, so they had to jack up wages. So actually, what made that non-transitory wasn't the initial supply shock from COVID. It was the fact that you did have a period of time, a year and a half, a wage price spiral. The prices did get fed into wages. But here he's telling us that he doesn't expect prices to get into wages, but yet he's still concerned about inflation. And I'm wrapping my head, are you trying to find any excuse, not even to ratify what the markets have priced in, which are basically 5 rate cuts? And he wasn't willing to go there for whatever reason. And I can only say, Rudyard, that maybe it's because he has less than a year left in his term as Fed chairman. And if he had to choose between recession or inflation, he'd probably choose the recession, because who wants to leave after the inflation experience of 2022, where his credibility got impaired? He rebuilt it. He did rebuild it. However, nobody remembers that Paul Volcker generated back-to-back recessions in the early 80s. They only remember Paul Volcker, and he's revered for having killed inflation. So I think that's basically, so it's telling me that the Fed is going to err on the side of restraint for some time. So there is, whatever the Fed put is, the strike price is a lot lower than what everybody thought, say, several months ago. I think that it all comes down to what your time horizon is. If you're a trader right now, or you have a 1 or 3 month time horizon, it's going to be gut-wrenching. I'm getting asked all the time about picking the bottom, to which I say, well, leave the bottom picking to the proctologists, because the rest of us aren't normally very good at it. But sentiment has been washed out enough that we're building up to a capitulation point. And sentiment is very important for the stock market. So I'm thinking that in the next couple of months, we're going to be getting a great buying opportunity, so long as you have a 12-month view. I have no reason to believe that we necessarily necessarily hit bottom, but let's face it, just pure arithmetic, we're a lot closer now than we were 6 weeks ago. And you have to also understand that the markets will always overshoot to the upside and then overshoot to the downside. And we're probably going to end up overshooting to the downside. So I would say that, if you have cash on hand, or if you're like me and you didn't participate and drink the Kool-Aid at the peak in the market, you're going to get a great buying opportunity. But you have to understand, you must have right now a 12-month view. If you're going to ask me, and this is coming from somebody who's notoriously conservative, but even if you believe I'm a perma-bear, I'm saying right now, you could buy the market now, hold your nose, and you'll be up 12 months from now. But you'd have to withstand a lot more near-term volatility and pain. It's hard to know right now how this is going to end. If you think that the tariff file is going to end, then I would say that you got to be relying on the Supreme Court or Congress taking these powers away from Donald Trump. There was a time where Congress controlled trade and tariffs, but no longer. So something's got to change on that score. It would not be waiting around for Donald Trump to change his mind. I don't think negotiations are going to go anywhere on this, or we just have to wait for the market to adjust and overpriced to the downside. I'd say right now we're between half and 2/3 away from the stock market pricing in a recession, which is probably going to happen. And so that's why I'm saying near term, I wouldn't say jump into the market with both feet. You can sort of scale in gingerly, because we're getting close to that point where the market's pricing in a recession, and then that's a good point to get in more aggressively. We're not there yet. And it's at that point when I can actually say, well, we have more than priced in the recession, and the way it's going, look, it could be a few weeks away. That's how dramatic this is. Now you're hearing another capitulation, which J.P. Morgan or it's Citi, UBS. Now everybody's calling for recession, and so you want to see more of that. And remember that it's not just about fundamentals that drive the stock market. It's a whole bunch of things that drive the stock market. Technicals, market positioning, but sentiment is very important. Right now, I would say, look, you're getting paid to be in cash. Bonds, I think, are a good place to be. But I'd say in the next couple of months, they will not be the best place to be, because I think great buying opportunity is going to be opening up. We're not quite there yet, but we're building up to that position.